Good afternoon, welcome to the market wrap for APW, week ending 16th of April. Stuart Williamson here at the helm. This week we're just going to cover some of the salient factors that are supporting the property market still in the UK. Some great quotes from the Daily Telegraph this week. They basically say we have the end of hibernation, and according to a survey that some research they did with Revolut Bank, they say that spending was 185% higher this last Monday than it was on any pre-lockdown Monday. Many people made a beeline for hairdressers, where spending was 323% higher than an average Monday. And the Revolut users spent £2,031.56 per minute in pubs. Now, it's no reflection on Revolut users, because I know some myself, but they're not necessarily heavy drinkers. But it's an indication that a lot of money from this 140 billion that's been built up is now being splurged. The Post Office said the number of cash withdrawals was up 22% month on month in March, and cash deposits were all-time high in the Post Office of 1.1 billion. So there's heaps of money becoming available in the UK. Now, a lot of that, according to Savills, is going to the UK property market. The shortage of homes for sale and the booming buyer demand has pushed up house prices in most areas. There are now 9 new applicants registering for every property for sale, creating the strongest sellers market in a decade. In fact, to quote, seemingly endless demand when desperate buyers are pushing up house prices. That's Savills. 14% fewer homes on the market for the first 3 months of the year, 17% more prospective buyers. So there's a mismatch. So how long is this going to go on for? You've got to look at what are the underlying supporting factors there. Okay, the stamp duty holiday hasn't ended, it's going on, but research has shown that the stamp duty holiday was actually getting people at the higher level of £1 million plus to buy, and not at the normal person at sub £500,000. So that sub £500,000 market is booming, but it's not because of the stamp duty. It's because of people wanting to move and it being a good buying opportunity for them. Why is it a good buying opportunity? Because we've got low interest rates. Now, Reuters recently did a poll of the top 70 economists in the UK, and they basically said they did not see the Monetary Policy Committee, which meets on the 6th of May, increasing interest rates before the end of 2023. So that's all-time low interest rates. There's little inflationary pressure, which is one of the things that will push up interest rates, according to, James Pomeroy at HSBC. He's saying higher inflationary pressures are still evident, with shipping costs, input cost indices and commodity prices going up. But at this stage, no need for alarm from the central bank. So low interest rates, high demand, a lot of cash out there. What else have we got? According to the same survey by Reuters, the top 70 economists in the UK thought that the UK economy would recover to the pre-COVID levels by mid-2022. So that's next year. I mean, that is again phenomenal. If you look at the global financial crisis, it was 10% smaller, the global economy, after the financial crisis. Now it's going to be back to normal. Again, in the developed markets. We're not talking about the emerging markets here, but with the best will in the world, we're looking at UK and European buy-to-let property, investment property, not elsewhere. So that's their view, is that it will return to pre-pandemic levels by the middle of next year. Paul Dales of Capital Economics said there are mounting signs that the effects of the economy from the third COVID-19 lockdown have started to thaw. We are sticking to our relatively optimistic view that the reopening of the economy and the vaccine program will allow GDP to be back to its pre-pandemic levels next year. In addition, Rishi Sunak said he expected it by mid-2022. So they're all people saying, okay, there's stacks of cash out there, let's go out and buy something. There's not enough supply out there in the marketplace. Low interest rates are going to continue to keep on pushing up the marketplace. Wonderful. And post-pandemic, the economy will get back to normal. Now, there will be some economic scarring. As the IMF said, in Europe, there will be not as much in the UK as there will be in continental Europe, and not as little as there will be in the US, which will be none. So there will be some jobs lost. And this takes us on to the final furlong, if you like that, of my talk, unemployment. Basically, the view is that unemployment, according to these top 70 economists in the UK, whoever they may be, that the unemployment will peak at 6.2% when a furlough finishes. It's currently at 5%, so there's going to be a fair amount of pain out there for a lot of people. But they're expected to be short-lived, and by 2022 to be back down to present levels, 2023 back down to less than 4%, which is the average. So we're looking very positive overall for the UK property market. We've got the splurge, we've got endless demand, we've got low interest rates, we've got the economy at peak pandemic levels by mid next year, and we've got unemployment not going to be as bad as we thought. So it's still a great buying opportunity. It's a case of, it's never the wrong time, it's never the right time to buy property. It's just a case of get in and hold. It's time in the market, not timing the market. You understand that? That's great. Thank you very much. Do take care, and hope to see you again next week. Don't forget to like, subscribe, and all those sort of things. Bye-bye.